Con 4, welcome back. We're going to be doing cost of production today. So today we're going to talk about industrial organization. We're going to focus a lot more on firms, why they make the decisions they do, why they price the way they do, why we look at certain quantities over other, certain cost structures, different competition they face or lack of competition for that matter. So basically industrial organization is looking at what markets they face, their cost structures, competition, all these things all mushed into one. So this class, or in this video, we're going to be looking at the cost of production, basically what's associated with your cost, whether it be different input prices like labor, land, capital, raw materials, natural resources, anything of that matter. So something I've been talking about since the day one of class, the goal of a firm is to always maximize your profit, minimize your cost. That's a constant. Nothing has changed through that. Now, when we look at profit, we're always going to look at total revenue and total cost. Total revenue is just price times quantity. Total cost is your fixed cost added to your variable cost. So fixed plus variable equals your total cost. So profit is total revenue minus total cost. Now, there's a couple of different things we need to look at. So, for example, what is fixed cost? A lot of students have a question with what that is. So, fixed cost is anything that is a fixed amount that you pay every single month or every time you produce a product. So, for example, think of a cost in your life that you always have to pay. A perfect example would be rent. You pay the same amount every single month for a certain period of time. So, your contract says, or your lease is for a year, you're paying the same amount every single month. Nothing is going to change. Now, a variable cost is something that varies over time. So let's just say, let's say you're a firm that produces pizzas. Now you want to be able to produce more pizzas, so you need to buy more tomatoes or more dough. So your cost is going to vary. Or if you hire one more worker, your cost is going to vary. Fixed cost is constant. Variable cost is constantly changing. So it can either increase or decrease depending on how much you want to produce. Now, from there, there's a couple different profits that we need to look at. We have economic profit and then we have accounting profit. So economists look at profit and so do accountants, and there's two different ways to look at them. So we'll first talk about how economists see profit. So economist sees opportunity cost. That's a big thing with economics, the study of trade-offs, of making one decision. So we factor that into our profit. Now, our original our economic profit is going to be total revenue minus your explicit cost plus implicit cost. So I'll talk about explicit and implicit in a second. Now, accounting profit, accountants just focus on how money comes in, how it flows throughout a firm. So it's total revenue minus explicit. Now, explicit is outlay of money. Basically, anytime you have to spend money out of pocket, it is considered explicit cost. So you have to pay your workers, it's explicit. If you have to pay pay for natural resources, explicit. If you have to pay rent, it's going to be explicit, something that you can easily trace and quantify. Now, implicit cost is opportunity cost. Now, we've talked about this. An example of this would be time. So let's just say your cost for a month is $10,000 to run your firm. Now, in this case, we would be, or as an economist, we would look at what else could you be doing with that $10,000. If you invested that $10,000 into the stock market, would you make more profit or less profit? If you invested that $10,000 into your education, would you be able to make more money in the future or less money in the future? So economic profit takes into account opportunity cost. Explicit or accounting profit does not. So in this case, your accounting profit is always going to be greater than your economic profit. So make sure you understand that for your exam and a quiz, a potential quiz question is accounting profit is always going to be greater than because it does not take into account opportunity cost. Economists, we take into account opportunity cost. So if you're producing at this quantity, at this amount, and your profit is positive, that means this is the best decision that you have on the table. Now, accounting profit does not look at opportunity cost. We don't look at what else could you be doing, what's the trade-off. You're not looking at that. It's just money in, money out.